Hi, I'm Lauren Hamilton, accountant for therapists. Today I wanted to talk about a scary topic, quarterly taxes. Ugh. Uh, I have to pay them, you have to pay them. How do we figure it out? Once we break it down into a few simple steps, hopefully that will help you kind of overcome your tax estimate anxiety and make better business decisions during the year. So let's jump into it. So let's talk about why we have to pay quarterly taxes. So when you're self-employed, you are not taxed on your earnings like you would be if you're a W-2 worker or if you're getting a paycheck from a company. When you're getting a paycheck, your federal and state withholdings are made so that way you're paying in your taxes during the year, and then lucky for us in America, we have to prepare a tax return to reconcile those at the end of the year to make sure we paid in enough, or if we paid too much, then we can get that money back as a refund. So, again, as you're a self employed person, you are not making those payments like you would through payroll. So, that's why we have to estimate these quarterly. And if you make those payments quarterly, then the IRS looks at that as an acceptable time frame, and you should not incur any penalties for what they call an underpayment penalty during the year. So, that's one of the reasons why we do it. And again, it's also just a great, it kind of makes you look at your finances during the year, where sometimes maybe we're just like a set it and forget it, and we don't really look at it until the end of the year. And then, everything's going to be a big surprise. So if we're looking at it quarterly, we can stay on top of it and make sure that we are calculating those estimates correctly. And that way there's not any of those big surprises at the end of the year. So, one of the biggest mistakes that I see therapists do when they are trying to estimate their quarterly taxes is waiting till the quarter end. And those tax payments are going to be due April 15th, June 15th, September 15th, and January 15th. Obviously, depending on when the 15th lands, it may not be exactly the 15th, but those are the dates that the IRS has dictated. So do not wait until like April 14th to figure out what your estimated tax payment needs to be. This is something that you want to kind of do consistently. And I would even say do a couple of weeks in advance. Again, because you want to make sure that you are gathering all of your necessary information to make the most accurate estimate that you can for the quarter. But waiting till the last minute can also just lead to guessing and, maybe not paying enough out of cash flow fear or underpaying and stressing about it later. The goal here is not perfection, it's just creating a reasonable estimate. So, first step is let's make sure you understand what it is that you're actually being taxed on. So, a lot of misconception can be that you're actually being taxed on the money that you're bringing in, like your income, your total income. And that is not the case. So, the way you calculate what your taxable income amount would be is taking your total income. So, that's all deposits from, insurance payments or private pay clients, anything like that that you are receiving as a deposit into your bank account that you are earning. That's your total income. And then you want to subtract out your business expenses. So those are everything from your software expenses, continuing education, rent, office supplies, session supplies, anything like that that you're capturing during that time period. You want to subtract that from your total income, and that gets you what we call net income or your net profit or loss. And that's what we also call your taxable income. This is why bookkeeping and keeping up with your bookkeeping, either monthly or quarterly, is so important, because if you're missing any income items or expense items, your estimate that you're creating is not going to be as accurate as it can be. So now that you have your taxable income amount, and if it is a positive number, then that is a what we call taxable income. If it's a negative number, that means you have a loss currently, and that means that your expenses are actually more than what you are bringing in. If it's negative, then you won't have any taxes to pay because you don't have any taxable income coming in. That could be a whole nother video. So right now I'm just focusing on if your number comes out to be a positive number, then that's what you need to estimate your taxes based on. So this is not a complex formula by any means. And I know formula is probably going to freak you out, but that's okay. It's, we're taking it one step at a time. So you're going to take your taxable income. And my general rule of thumb, and I think mainly the industry's rule of thumb is to set 20 to 30% of your taxable income aside for taxes. So you're going to take your taxable income number and take 20 or 30% wherever you kind of feel comfortable and get that number, and that is going to be your tax estimate. If you're early in your practice, you might want to start higher at that 30%. Again, this is also going to depend on your other personal items that you have. So if you do have a partner that is generating income that is going to go on a personal tax return, that's going to factor into this. So again, this is just a general and broad calculation for just your practice income. The main thing is that you just want to be consistent with this. So if you start with 30%, I would stay with 30% throughout the year and for each quarter after. Same with if you're doing 20%, just stay with 20%. You can always adjust it later, but again, consistency is always the key when you're talking about accounting. Okay, so now that we have your estimated tax amount, how do we save for that, or how do we make sure that that is getting paid on to the government on time? So sometimes people like to set up a separate tax savings account. So you can actually, make a transfer monthly if you want to. You can go through that calculation process and, let's say just for round numbers sake, you want to set aside $1,000 each month to your tax savings account. You can make that a reoccurring transfer from your checking account to this tax savings account. So that way, when you do go to make those tax payments, you can use that tax savings account and know that you have enough funds in there to cover that transfer. The other nice thing about that, again, is it just creates, a sense of security, knowing that you have that already set aside. So that way, when you do go to those payment deadlines on either April, June, September, or January, you have those funds set aside. So again, this is a quarterly practice. I don't think you necessarily need to do this weekly or monthly, but definitely look at it quarterly. This is what I like to do with my clients is, take a look at the previous quarter. How did it go? Was there a seasonality income change where maybe you weren't seeing as many clients, or maybe you were seeing more than what you normally do, and just making sure that you're taking that into account when you are creating your estimates. And then also starting to plan for the next quarter. So just thinking about, if you're going into the summer season, is that a time where maybe you don't see as many clients, or maybe you're adding a new revenue path where that might generate more income in the next quarter. And so just kind of keeping that in mind, so that way, you can either make an adjustment to your transfer that you set up to that tax savings account, or you're just aware of what it is that you're going to be putting aside for those taxes. And again, to make these estimates reasonable and as accurate as you can, you want to keep up with your bookkeeping and you want to keep up with your accounting. So as we're going through this and talking through it, you might have the little fear voice in the back of your mind saying, but what if we get it wrong? So most of us are not going to get it right 100% of the time, because again, this is an estimate. It's an estimated payment. We're just making an educated guess based off of the data that we have from our bookkeeping and accounting, and making that calculation based on the percentage that we set for ourselves. So if you do get it wrong, all that means is, if you've overpaid, which most people think is a, good thing, that means you'll get a refund at the end of the year. If you've underpaid slightly, then you may owe a little bit more in your taxes, but that's what we're always trying to get to the break even point. So a perfect tax return in my mind is when zero is due and zero is owed back to you. Which means that you were paying in the right amount throughout the year. I have been doing this for 15 years. I have never seen a tax return that comes out to zero. So again, it's very hard to get that number correct because there's just a lot of factors that go into your tax return. There could be some exceptions to that, I guess I should say. But again, I have never seen a tax return when you put all of the information in from the year and the tax return comes to zero. So this isn't as black and white as is it right or is it wrong. The main thing, again, is you want to get it as reasonably accurate as you can. Otherwise, if you're severely underpaying during the year, you're going to owe a bigger penalty for that. But if you're getting it in a reasonable amount during the year, then that penalty is either going to be non-existent or very small at best. I mean, this is very normal for self-employed people, and it's something that we all have to determine. I have to do this in my business as well. So it's not an audit trigger. And just because you feel like you're not good with numbers or all of this seems overwhelming, a lot of people feel that way. And that's exactly what I like to do with my clients, is help them look through this quarterly, especially if I'm the one doing the bookkeeping. I'm going to be able to see those trends as they go through the months, and I will be able to flag those items and say, hey, it looks like we might need to be paying a little bit more in tax this coming quarter, and give you the information you need to make those decisions. So if you feel like you need more support in this area, again, this is what I like to do with my clients. One way to get started with this is to take me up on my offer for a free financial health check. And what I like to do there is actually go into your accounting, review everything that you have so far, give you some suggestions on where you might be miscategorizing things, if your chart of accounts needs to be cleaned up a little bit, or if I see any personal expenses mixed in with your business expenses. So I will give you a comprehensive review scorecard, so that way you can take that and improve your accounting for going forward. Also, just keep in mind, this is stuff that you were not taught when you were, going through grad school or any of your therapy training programs. And this is what I like to do. And this is, my training and my specialty. So I would love to help you out, and I hope you found this video helpful. If you did, please like and share it with another therapist who will find it helpful. And until next time, be well.